Today, stormy weather kills the wealth effect. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. So this is our weekly market update, and what a week it's been. We'll start in the US, then go around the world and end up in Australia. This week, of course, the US Federal Reserve announced an interest rate hike of 75 basis points. That's the largest increase since 1994, while the Swiss National Bank unexpectedly lifted rates by 50 basis points on Thursday, and the Bank of England on the same day raised its interest rates by 25 basis points, hiking for its fifth consecutive meeting. The main outlier is the Bank of Japan, which stuck with its strategy of pinning 10-year yields near zero at its policy meeting on Friday. However, this has done little to ease worries that inflation and rate hikes are going to curb economic growth for years to come. And it was also one of the most dramatic weeks in the short history of the cryptocurrency market, bookended by the type of announcements investors fear the most from a counterparty. We're sorry, but we just can't return your money right now. It all started late last Sunday when a sort of crypto shadow bank called Celsius Network suspended withdrawals from depositors who had been enticed by sky-high interest rates that, in retrospect, were likely too good to be true. And by the end of the week, on the other side of the world in Hong Kong, the digital asset lender Babel Finance also froze withdrawals. Just as Bear Stearns hedge funds were among the very first to reveal problems from the subprime mortgage crisis, the cockroach theory springs to mind. If you see one or two of those nasty bugs scurrying across the floor, chances are there are plenty more hiding behind the fridge or under the sink. Wealth destruction is now a thing. Federal Reserve officials rolled out strong language on Friday to describe their approach to inflation, promising a fully fledged effort to restore price stability. In its annual report on monetary policy, a precursor to Chairman Jerome Powell's appearance before Congress next week, the central bank promised it would launch a full effort to bring down inflation pressures running at their fastest pace in more than 40 years. The committee's commitment to restoring price stability, which is necessary for sustaining a strong labour market, is unconditional, the Fed said in its report to Congress. That marks the Fed's strongest statement yet, affirming its commitment to continue raising interest rates and to otherwise tighten monetary policy to solve the economy's paramount issue. And in fact, earlier in the day, Powell himself said that he and the rest of the Fed are acutely focused on bringing down inflation. And he reiterated the Fed's commitment to fight inflation and talked up the strength of the consumer, even as a slump in the stock market has made a dent in household incomes. Recent indicators suggest that private fixed investment may be moderating, but consumer spending remains strong, Powell said. But the outlook for the US economy continues to darken, and a June update of economic forecasts generated by the Federal Reserve Bank of New York's dynamic stochastic general equilibrium model are bleak. According to the model, the probability of a soft landing, defined as 4-quarter GDP growth staying positive over the next 10 quarters, is, well, only about 10%. Conversely, the chances of a hard landing, defined to include at least 1 quarter in the next 10, in which 4 quarters of GDP growth dips below -1%, as occurred during the 1990 recessions, is about 80%. They said changes in the near-term forecast for GDP growth and core PCE inflation relative to March reflect two factors. The first is a continuation of the cost-push shocks that have hit the economy since early 2021, resulting in a higher projection for inflation and a somewhat lower projection for output growth. And the second factor is tighter monetary policy in 2022 and 2023, with the federal funds rate following a much steeper path over the next year and a half than the one projected in March. The latest economic data, however, continue to flag building inflation pressures. Industrial production fell short of economists' expectations in May, but rising utilisation rates caught economists' attention. High utilisation rates correlates with higher inflation and is not far off the highs reached last cycle, Jeffries said in the Post. Gross domestic product declined 1.5% in the first quarter, and the Atlanta Fed expects the second quarter to be flat. Consecutive quarters of negative growth are considered a rule of thumb for a recession, although the National Bureau of Economic Research says it uses other factors as well before making an official declaration. But let's face it, the Fed Reserve waited too long to start fighting inflation and now runs the risk of dragging the economy into a recession, and that's according to Bank of America's top economists. On the heels of the central bank's 75 basis point rate hike on Wednesday, Bank of America global economist Ethan Harris said the Fed is being forced into such aggressive moves by inflation now running at its hottest pace since late 1981. Our worst fears around the Fed have been confirmed. They fell way behind the curve and are now playing a dangerous game of catch-up, he said in a note to clients. We look for GDP growth to slow to almost zero, inflation to settle at around 3%, and the Fed to hike rates above 4%. Now, Harris isn't predicting a recession yet, but said the probability of one happening in 2023 has risen to 40%. Where we disagree with both the Fed and the market is the idea that the Fed will be cutting in 2024, Harris wrote. That is certainly possible if there is an outright recession. However, our baseline forecast assumes the Fed will be like a deer in the headlights, unsure over whether to react to very weak growth or still high inflation. And David Einhorn, who's been a long-time warner about the Federal Reserve's inability to engineer a soft landing, said the Fed is bluffing before the 75 basis point rate decision. Inflation isn't going away so fast. The Fed really doesn't have the tools to stop the inflation. And he said recently that there is a long-term case for gold, saying bullion could emerge as the ultimate financial insurance for investors. When countries don't trust each other over bonds and currencies, gold becomes the ultimate reserve asset. Gold, as a percentage of total reserves, remains staggeringly low, Einhorn says. The question is whether there's enough gold to back the currency reserves. The answer is perhaps for the price of gold to go higher, perhaps much higher. So, overall, stocks whipsawed this week, with the S&P posting its worst weekly loss since January, a sign the market believes the Fed will continue to struggle to get on top of inflation. The Dow Jones Industrial Average fell 0.1%, the Nasdaq was up 1.4%, and the S&P 500 rose 0.21%, but that ended the week nursing the biggest weekly loss since 2020. Tech, which is down nearly 30% year to date, rebounded from a rout a day earlier, though the 10-year bond was at 3.23% and the 2-year at 3.1701. Apple and Meta platforms were up by more than 1% each, and they led the gains for big tech. Adobe Systems, though, cut some losses to trade down 1% after the software market cut its growth outlook, citing tougher macroeconomic backdrops, including the impact from the Ukraine-Russia war. The stock is likely to remain under pressure until investors can gain confidence that the expected declines in F3Q, net new digital media ARR, and the operating margin are transitional, and EPS growth can return to growing faster than revenue, Oppenheimer said in the note. Consumer discretionary, which has come under increasing pressure on worries that a weaker economy is likely to squeeze the consumer, also racked up some gains as investors piled into beaten-down travel and leisure names. Carnival Corporation, Norwegian Cruise Line, Booking, and Expedia were among the biggest gainers. Energy, meanwhile, fell more than 7% after oil prices fell on fears about weakening demand as recession jitters grow. US crude futures traded lower, while the Brent contract fell for the first weekly decline since April. Additionally, gold futures fell slightly to 1,841, and the US dollar index futures was up 1.13% to 104.65, while the VIX was down to 31.13. Diamondback Energy, Devon Energy, and ConocoPhillips were the biggest decliners in the energy sector. In other news, CGen jumped 12% on reports the company has been in talks with Merck for a while concerning a potential sale. The rebound on Wall Street has sparked debate on whether this marks a relief rally that will prove short-lived or the makings of a prolonged move higher. Some on Wall Street have suggested the market is close to finding a bottom. Likely more to go in terms of market challenges over the short term, but many of the metrics we track are closing in on levels that were associated with prior bottoms, January Montgomery Scott said. European stock markets were mixed to the close on Friday, following the previous session's sharp losses on fears that aggressive monetary policy tightening could lead to a global slowdown. In Germany, the DAX traded 87 points higher to 13,126, while the CAC 40 in France was flat and the FTSE was down 28 points to 7,016. The main European indices had posted hefty losses on Thursday, with the DAX down 3.3%, the CAC 40 down 2.4% and the FTSE down 3.1% in the wake of the series of global central bank tightening monetary policies to tame red-hot inflation and, of course, sparking those worries of a significant economic slowdown. The latest release of Eurozone consumer prices for May did confirm growth of 0.8% in the month and up 8.1% on the year, with energy rising close to 40%. That's well above the 7.4% in each of the previous 2 months and 4 times higher than a year earlier. The US dollar was flat at 1.05. Asia-Pacific stocks were mixed on Friday. Japan's Nikkei 225 fell 1.77%. South Korea's Kospi fell 0.43% to 2,440, while Hong Kong's Hang Seng gained 1% to 21,075. And China's Shanghai Composite was up slightly to 3,316. Japan's 10-year bond yield hit 0.318%. That's the highest since 2016, after the Bank of Japan maintained its ultra-easy monetary policy in contrast to the aggressive tightening of its peers. This very loose monetary policy places the Bank of Japan in a room on its own after the US Federal Reserve, the Swiss National Bank and the Bank of England all hiked those rates this week. Japanese officials tried to provide some support for their beleaguered currency earlier on Friday, with the government and central bank issuing a rare joint statement stating they were concerned by recent sharp falls in the yen, the strongest warning to date that Tokyo could intervene to support the currency as it plumbs 20-year lows. The yen remains vulnerable, especially if some stabilisation in risk sentiment lifts safe haven support to the currency and leaves it exposed to the evidence of sharply rising yields and hawkish Fed tightening, said ING in the note. We continue to flag the elevated risk of the US dollar Japanese yen breaking significantly above 135 in the coming days unless Japanese authorities step in with foreign exchange intervention. There is a building expectation that the Bank of Japan will need to amend its policy stance closer to some version of normal BMO capital market strategist Benjamin Jaffrey and Ian Lingham said in a note. Australian shares suffered their worst week since the pandemic-induced meltdown in 2020, tracking Wall Street on fears that aggressive policy tightening would induce a recession. The S&P ASX 200 fell 1.8% to 6,474 on Friday. That's the lowest in 18 months, and it's dropped 6.6% in the week, the biggest such tumble since March 2020, and it follows a steep 4.2% slide last week. The All Ordinaries lost 1.8% to 6,663. The mood was already sombre after Wall Street tumbled overnight. On Thursday, the rout continued in Asia, with MSCI's broadest index of Asia-Pacific shares and Japanese Nikkei also underwater. Out of the index 11 sectors, consumer staples was the only category in the black, with a gain of 0.6%. Materials was the hardest hit, dropping 2.8%, followed by tech stocks off 2.4%. All 4 major banks slipped, with CBA, Westpac and ANZ touching their lowest in a year in another horrendous week for financial stocks. CBA dropped 3.6% to 87.26, ANZ fell 1.6% to 21.17, and Westpac showed 0.7% to 19.19. NAB tumbled 1.7% to 25.92. Bank shares have been slammed on worries the Reserve Bank of Australia's more aggressive tightening would lead to a spike in bad debts, higher funding costs, and tougher times ahead for the mortgage market. Macquarie Group treated 3% to 159.70, but Magellan bounced 1.8% to 12.48. Hum shares plunged 21.7% to 45 cents after Latitude Financial canned its merger plans with Hum Group. Hum director Andrew Abercrombie, the company's biggest shareholder, instructed shareholders to wait for a better offer, saying the deal undervalued Hum's consumer finance assets. Falling oil prices weighed on energy stocks on demand concerns after central banks in the US and Europe raised interest rates this week, some by amounts that shocked markets and hinted at even higher borrowing costs to come to tame soaring inflation. Santos dropped 2.8% to $7.79. Woodside shed 0.9% to $31.92, and Beach Energy declined 1.2% to $1.69, though persisting supply tightness and new sanctions on Iran limited the downside. Washington also imposed sanctions on Chinese and Emirates companies and the network of Iranian firms that help export Iran's petrochemicals. And it was also a tough session for mining giants due to falling iron ore prices after Chinese steel mills reduced output amid weak profits and lower demand. Not helping was China's plans to consolidate the country's iron ore imports through a newly centrally controlled group by the end of this year, as Xi Jinping's administration seeks to increase Beijing's pricing power over the industry. Rio Tinto skidded 4.2% to 107.01, and BHP Group shed 3.4% to 42.52. Fortescue Metals retreated 5.2% to 18.60, and Fortescue CEO Andrew Forrest assured investors that its low-cost base and green energy plans left it well placed to weather the storm of rising borrowing costs, soaring inflation, and slower growth. But gold miners were among the rare stocks that enjoyed gains. Evolution Mining rocketed 5.4% to $3.69. St Barbara jumped 6.1% to $1.21. And Northern Star Resources lifted 5.1% to $8.60. Infant formula and dairy company Bubs Australia shot up 9.1% after materially upgrading its fiscal revenue and earnings expectations amid strong demand in China and chronic shortages of formula supplies in the US. Tech shares slid further, with Afterpay owner Block down 7.8% to $81, followed by Xero down 5.6% to $73.52, and Life360 off 4.2% to $2.51. Shares in G8 Education added 0.5% on plans to increase fees, and Gold Coast-based G8, which has more than 450 centres trading under the brands including Pelican Childcare and Kinderhaven, are lifting fees 3.5% on average from July, having already jacked up prices 6% in January to boost margins. Talk about inflation. Shares in cattle and beef producer Australian Agricultural Company leapt 9.9% to $2.22 after Andrew Forrest's family more than doubled its stake in the company, taking out Paul Holmes Court Hydesbury in an aftermarket crossing. The index's biggest laggard was designer, manufacturer and distributor of automotive products, GUD Holdings, down 19.6% to $7.30 after downgrading its guidance due to supply chain disruptions. And finally, cryptocurrencies could be on the brink of collapse, and it's confirmed as history's craziest asset bubble, as central bankers signalled their determination to aggressively lift cash rates in a non-negotiable fight to control runaway food and energy price inflation. This painful reality is likely to haunt the estimated 8% of Australians who held crypto in 2021, as a 7-month bear market that's delivered history's largest and fastest wealth wipeout, more than $2 trillion, threatens to accelerate. Australians alone may have tipped $20 billion into cryptocurrencies over 2021, with average losses now sitting around 70%, according to Ballpark Takeout from one big Australian bank. The DeFi platform Celsius suspended withdrawals this week. The experimental unregulated sector's existential threat is being delivered by soaring risk-free rates, as Australian government treasuries topped 4% for the first time since April 2014 over the last week. By comparison, in April 2014, Bitcoin traded at just $450 versus $20,200 on Friday, and way off a high, of course, of $68,000 last November. This shows how crypto could extend losses as the macroeconomic environment normalizes and as crypto has failed to establish itself as a hedge against inflation, a store of value like gold, or payment methods for goods and services akin to money. In other words, what the heck is it? Gold, for example, has climbed around 3%, from $1,792 an ounce in November to $1,849 on Friday, to show its utility as a store of value in times of financial crisis or soaring inflation, while Bitcoin has plunged 64% over the same period. Decentralized cryptocurrencies like Bitcoin cannot exist as a unit of account or reserve of future purchasing power like fiat money because their value is far too volatile. For example, an employee who agreed to be paid in Bitcoin last November would have taken a 64% pay cut by this week. For now, cryptocurrency's only real use has been an asset price speculation. The decentralized finance corner of crypto was also taken an especially large clobbering over the past week with the collapse of industry players Celsius and 3 Arrows Capital after last month's implosion of digital coin Luna. DeFi's promoters claim it's the functionality of projects in offering traditional finance services on a blockchain that supports cryptocurrency's intrinsic value. But Celsius is one of hundreds of DeFi businesses that offer double-digit interest rates on deposits with little disclosure on how this kind of financial alchemy is achieved and zero regulatory protection for depositors. Given the lack of regulation, DeFi depositors will often look reliant on the goodwill of product providers not to rip them off or steal their funds with no guarantee deposits. Safe. Before its liquidity problems, Celsius reportedly had around $12 billion of assets, while venture capital fund 3 Arrows is reportedly on the verge of bankruptcy after last reporting $18 billion in crypto assets under management. Last May, of course, Luna coin holders lost $85 billion after its value plummeted to zero in another withering example of DeFi's sector's credibility. On Wednesday, the world's largest crypto exchange, Coinbase, announced it was going to make 18% of its workforce, or 1,100 staff, redundant as it attempts to survive the crypto winter. Coinbase shares are down 85% since listing on the Nasdaq just in April 2021. The industry turmoil came over the same horror week. Microsoft founder Bill Gates said cryptocurrencies and non-fungible tokens are 100% based on greater fool theory. The strategy of relying on greater fools to pay more is likely to be tested over the next 18 months if it's possible to earn 4% or more on the term deposit as central banks aim to bring inflation back down to 2%. Cryptocurrency investors also tend to be price followers in that they'll buy whatever is going up and sell whatever is going down, rather than investing in assets such as a property or stock that offers utility, future cash flows, or both. The price follower phenomenon spilled over into share markets during the pandemic as many retail investors monitored social media to buy whatever stocks were rising the fastest. In Australia, popular buy now, pay later and tech stocks like Zipco and Sezzle surged to prices above $14 a share and $11 a share respectively, but now both have slumped 95% since. And in the US, Afterpay owner Block bought $170 million of Bitcoin in February when it traded around $45,000, but has created nearly 80% since. The speculative bust has taken the biggest toll on loss-making tech businesses. While cryptocurrencies were sold on the idea that they were free from regulation and the shackles of central banks, ironically, now look likely to be brought crashing down by their own self-made enemies. And in fact, with crypto prices tumbling precipitously, traders have begun increasingly turning one against another to eke out ever-elusive profits. Many sharp traders scour blockchains, digital ledgers for recording transactions, seeking information on other traders, particularly those with highly leveraged positions, one anonymous user said. The sharks then attack the positions by trying to push them into liquidation and earning liquidation bonuses that are common in decentralized finance, where people trade, lend and borrow from each other without intermediaries like banks. Related strategies may have contributed to the collapse of the Terra USD stablecoin, with shark traders making money off price arbitrage between the Curve decentralized exchange and centralized exchanges, according to a blockchain analyst firm, Nason. Recent troubles in crypto lender Celsius network were exacerbated by arbitrages too. The price of STETH tokens that Celsius has a large position in started trading at a large discount from Ether, to which it's tied. As the STETH goes down, arbitrages buy STETH and short ETH against it. sending ETH lower, which again lowers collateral values across DeFi, effectively worsening Celsius' position. And as they put it, in a downtrend environment where yields are harder to access, what you are going to see is some actors utilising some more aggressive strategies, and that may not be necessarily good for the community. The environment has become more player versus player. With crypto prices under pressure, taking on leverage has presented an ever greater peril. Last year, Sushi launched a margin trading and lending platform. Most crypto exchanges offer margin trading, and in the past it has been as high as 100 times, meaning that people were able to borrow 100 times what they put down as collateral. Most DeFi apps require traders to over-collateralize, however, effectively taking out less in loans than they put in. A trader may find out that others could get liquidated. When a coin's price drops to, say, $100, the trader could then build up a sufficient position in the coin, then sell in order to pull the price below $100, while also collecting the reward for liquidating the trader that most DeFi apps offer. Most protocols offer a 10 to 15% liquidation fee. Triggering enough liquidations would cause a liquidation cascade where a motivated actor could simply hold a short position in order to profit for the subsequent secondary decrease. Other traders are simply profiting off liquidations they don't trigger. Nathan Worsley runs a slew of bots, software programs that search for traders who are about to get liquidated, and gets paid a commission for liquidating them. Recently, the amount of liquidations has been huge, Worsley said in emails. However, liquidations is not a continuous strategy. You sometimes go for a week or more without any significant liquidations. However, when liquidations happen, there are usually a lot at once. You basically have to work a long time while making nothing in order to be ready for the big day or two when you might be able to make $1 million at once. His bots continuously scour blockchains, keeping a list of all the borrowers using a particular app and scrutinizing the health of their accounts. Once positions are ready for liquidation, it's usually a battle to be the quickest and perform the liquidation. Worsley explained, "I would push back on classifying this as an attack." He adds, "The reason is that without liquidations, you can't have a lending market. So even though no one enjoys being liquidated, it's essential that people do get liquidated in order to make the market and protect the protocol from insolvency." Liquidations can be triggered after traders borrow from apps like AV or Compound and put up collateral, say like Ether, that's typically greater than what they borrow, perhaps 120% of the borrowed funds. If Ether's price drops, that collateral may now be worth only 110% of what the trader borrowed. "My job as the liquidator is to protect the protocol by closing your position," Worsley said. "The protocol gives me a reward for being a liquidator to encourage this activity because blockchains cannot move by themselves. You've borrowed $1,000 of Bitcoin, so I repay the $1,000 of Bitcoin you owe the protocol. In return, the protocol gives me $1,000 of your Ethereum collateral plus a $100 liquidation bonus from your excess collateral. I've made a profit. You've been liquidated and your position is closed, and the protocol itself has been protected from bad debt." With liquidation targets becoming more and more tempting in a tumultuous market, it's generally worth saying everybody should stay safe, everybody should avoid using leverage. Despite the similarity of past crises in traditional finance, there is one big difference. As the weekend approaches, players in the old-fashioned markets at least get to turn their machines off on Saturday and Sunday to get some sleep and lick their wounds. And as the 3-day holiday weekend approaches in the US, with forecasts of sunny skies in New York, those with heavy exposure to digital assets will remain glued to their screens, where crypto winter's deadly blizzard shows little sign of letting up. And more broadly, wealth destruction is now a thing, and I think the main question that people need to ask themselves is how do they safeguard against it? It may be too late for many, but of course, don't get more leveraged and get less leveraged is a good piece of starting advice. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.